Hey folks, welcome back to this edition of Ben's Bits. Last week we spoke about hedging your portfolio and reducing your exposure when you're using your investment vehicle of choice. And it seems that many of you agree with us that hedging is certainly an overly used buzzword, but we of course want to limit losses when we invest so that we don't have to start over. That is a very big deal. But the point of that was to highlight that the sophisticated investors that we speak with every week, we use multiple investments to spread the risk because we don't want to put capital at unnecessary risk, kind of putting all your eggs in one basket, if you will. It's much harder to have to recoup and grow when we're certainly of the belief that it's more prudent to take the lower risky investment than to take a higher risky investment and lose because, again, it's harder to recoup and grow because there's less capital at play. And this week we want to discuss inflation because we've been getting a lot of questions centering around it. And our thoughts on the matter are one question that really in particular is why all of a sudden now is the Fed stepping in and attempting to control inflation and raising rates to, say, 2%. And what's interesting is that according to Nomura, they believe that the Fed will increase rates by 50 basis points this month and 75 basis points in June and July. Now, we'll see if that happens, but we'll certainly keep an eye on that and keep it on the radar. Most speculators believe it's so that they can control what's happening. That's no secret. This entire time for many years, since we came off the gold standard in the early 70s, we've been seeing inflation every year. We even had a bid on that late last year using candy as an example. Now, if you've been paying attention to what's making the rounds, it went from transitory to now inflation is here and now there's a need to raise rates to try and control it. The real question is can inflation be stopped by raising rates? You can trace all the way back to the late 70s, Paul Volcker. He was the Fed chair at the time and he had to raise rates close to about 20% to stop raging inflation. And when it hit, say, 7-9%, and the juggling game really gained traction, this is the case that history wanting to repeat itself, right? With everything happening right now, do you think that Powell is going to raise rates to 20%? Well, we don't think so, but time will tell. We do think that we can see runaway inflation, though, because that's what the data is showing. And data across the board. And there's big neon signs for, if you're looking for them, that people can see. Now, that's why you're hearing talk of hyperinflation, and we're certainly keeping an eye out, but we think it's more likely that we'll see small incremental increases to attempt to showcase, if you will, that'll be enough to take care of it as they struggle to keep it going. And they have to do something or the whole thing will collapse. What we think is what's more likely to happen is we'll see something hit the derivative market that will start the dominoes falling, if you will. But that's another topic for another time. That's it for this edition of Ben's Bits. And as always, thanks for watching and we'll see you next time.